So let's have a bit of a look at France. First off, read this disclaimer carefully. And do your good deed of today by liking and subscribing. So, I did initially consider making a video here about Russia, actually the Russian stock market. The thing is that I do think that it's extremely risky to invest in any like American listed, like Russia ADR or like an ETF that gives you exposure to Russia, but that is listed on an American stock exchange. But there's a lot of people now who are, the big brains who are investing big in Russia at the moment. But in order to do that safely, you basically just have to use a Russian stock market platform. Okay, but yeah, definitely huge opportunities there if you have a long-term horizon. And also, it's very important to be aware that the number one thing that has contributed to peace is economic interdependence. Okay, so literally the opposite of sanctions. Okay, so what I will make a video about is France, because there's something interesting happening in France. We obviously have a massive downtrend. It is in a bear market, minus 21%, and we have had a 5% sell-off here on Friday. Okay, so let's just look at the charts. So these are weekly data points. This is, big picture. So the interesting thing about the France stock market is that it loves time cycles. It's huge on time cycles. The cycles have, however, differed significantly in size. So here we had a period of these large time cycles, and they were very clean, pretty squeaky clean. But then we had, all of a sudden, let me draw that in, we had a period of smaller time cycles. So let me draw in the time cycles. So something around here, you see that time cycles were pretty darn good at calling, the rises and the declines. We are currently part of a major declining phase. If we look at, the previous major time cycle, it was actually punctuated with two smaller ones within. So approximately something like this. It is possible that this current major time cycle is also going to have two cycles within, because that's been a bit of a theme. You see that also here as well. You could see that 1 and 2, and here also it was a bit 2-ish over here. So it is possible that we will see a bit of a rise now, but that we still are actually part of a major declining phase. What is especially important at the moment is that we are at big boy support, like huge horizontal support. So let us draw that in. So the 200-week moving average, it has been relevant for quite some time as support, but it can also be a resistance. So here are some previous times where it's been support, and it's been a pretty good time to actually buy the French stock market. But this moving average can also become a very ferocious resistance levels when we fall below it, as you see here and also here as well. So basically, this is a moving average that really matters for the French stock market. It's obviously watched by a lot of people, and this relationship between price and the moving average is not random. Okay, so we are at that level now. So from a purely technical standpoint, this says buy. But obviously, we need to look a bit further than that. So if we go here to the daily data points, we are below all moving averages, being a very violent sell-off. You could make the case that we are at horizontal support. So let me draw that in. So you have some horizontal support back here, and also here. Here you have 1, 2, and 3 tops that could help form, the current support, horizontal support level. So on the daily data points, you do have some case that maybe we will see at least a bounce. Looking here at, the RSI, we were more oversold on the weekly RSI back here during the lockdown plunge, so that is possible. Looking back here, the current RSI level formed low. Here, very similar RSI level formed the key low, and also back here as well. Here, so you see that the current RSI level has a very good track record of forming lows, except in times of pure liquidation break like we had during the lockdown. So let's also look here at the daily data points. We get a very similar message. We are very oversold. both on the RSI and also in terms of the PPOs. But there's a big but. During previous liquidation breaks, panic, full bore panic in the market, we have seen far lower levels. In terms of the accumulation distribution indicator, it actually is, it's looking rather strong. If you compare that indicator to price itself, then it actually is holding up decently. So let's go here to the laboratory. So in terms of the line in the sand, I think the key thing here is 200 weekly moving average support. It's such a key thing. That is the clear line in the sand. So in terms of the technicals, looking what happened previously, did these readings usually benefit bulls or the bears? Well, it usually had a better benefit for the bulls, except in times of liquidation break. So I will give this one to the bulls, but given that we can see a full bore panic, which we have seen not that far back, I think I will only give the bulls here a 3. So let's now look at seasonality. So to the right here, we do have the seasonality over the last 5, 7, and 10 years. And we do see that usually the seasonality strengthens nicely actually here, peaking towards early May. So the seasonality here to the right here, looking purely at the averages, it's good for France. To the left, we do see it in a bit of a different way. Over the last 5 years, March has been weak, April has been ridiculously strong. Over the last 10 years, March is 50-50, but April is just obscenely strong. And then over the last 20 years, then we do see that from February, March to April, we do see a nice strengthening in seasonality. So we are now in a time that tends to be favorable to the bulls. So in terms of the seasonality, so the small time cycles we found suggest that there is a very, very real possibility that we will see a small rising phase within a major declining time cycle phase. But that also gives a bit of a point to the bulls. The seasonality here was actually bullish, but it was especially bullish for April. March, which is the current month, it's a bit more mixed. But I do think that it makes sense to give this one to the bulls. So yeah, I will give it slightly to the bulls. I think I will give it a 3 here as well. Like that. Next, we will look at fundamentals. So we are comparing France with America, reflected with the S&P 500. So here is the performance. So we have seen a very substantial sell-off year to date in France, twice as much as what we saw with the S&P 500. In terms of the beta, they literally are identical, so just as volatile. The PE is higher here for France, 27.5 versus 21.7. The dividend yield is a bit higher, 1.5 versus 1.22. When we go here to the holdings, so here we got some luxury on the top, Louis Vuitton, definitively an extremely discretionary stock. And also L'Oreal, also very discretionary. Basically, they produce products that you don't really need. When we scroll down here, we do see that consumer non-durables, they make up 53%. That is very heavily tilted towards consumer non-durables. So in terms of sector breakdown here, you got much more diversification here in the S&P 500. So yeah, the French ETF, given that consumer non-durables is so high up on the list, so it is definitively very tilted towards. Here also you have Hermes International. They make luxury products. These are the kinds of things that these businesses will definitively be affected by the major crackdown on all kinds of oligarchs and their business partners. Okay, market cap breakdown, very, very tilted towards large caps, but you do get a little bit of mid caps as well, 7% here for France. When looking here at the fundamentals, it's also very much, the score is very dependent on the context as well. Because if we were in an economic period of a big boom, then it would actually be bullish that you have a lot of very discretionary stocks in France, that are a big part of the ETF. But in a time of literal war, uncertainty, then having a bunch of very discretionary stocks in an ETF, that isn't bullish. So I do actually think I have to give this one here to the bears. Bears actually. Also, the yield was not really that good. Price earnings also was not really that good. So I actually think I a bit harshly must give it a -4 here on the fundamentals. Then finally, we will look at relative performance. So here we do have correlations between France and the S&P 500 at 91%. Then we have 99% with WGK, which is the European stock market ETF. 71% with the Euro index. And then we have 27% here with gold. Short-term correlations is 61% SPY. And we have 90% with the Europe ETF, and a meager 6% here with the Euro, and minus 37% here with gold. So what is going to have the biggest impact on the France ETF is definitively going to be the VGK. So let's do a quick technical analysis of that one. So here is VGK. This one as well, it is actually a bit below the red 200-week moving average. You can see here that in the past it's been a very important moving average, but this ETF does not really have it doesn't have a clean relationship with that support level. When we look here to the right, we do see that we are very oversold. The vast majority of times where we were at these oversold levels, we did see rallies, at least either some mean reversion or longer term lows. But similar to France, there have been times like in 2008 and also during the lockdown where we had this panic in the market and we set records in terms of RSI oversold and also PPO oversold. And the PPOs, they measure the difference between price and various moving averages that you see here to the left. Now let's quickly look at the daily data points. Yeah, very similar message. There's a reason to expect a bounce, but there have been times of pure panic not that far back. Here is the France ETF against the VGK, which is the Europe ETF. So here we are looking at whether there's some interesting patterns in terms of outperformance, underperformance. We do see that the France ETF has definitively weakened here against the broader Europe ETF. You could make a pretty darn strong case that we come from a double top pattern here. That is, for all intents and purposes, very much so a bearish technical pattern. When we look here a bit in the past, you see that double tops have mattered before, like here and here. Then we did actually see some weakness. Here we got some double top, and we got weakness. So, yeah. And you also here as well. Here also you got the double top, and we did see more weakness. But we have already seen, though, a very substantial pullback from this recent double top. So let's see if the seasonality gives us more intel. So looking at the seasonality here, we do see that the France ETF tends to strengthen against the Europe ETF heading towards the 27th of April. So the seasonality here kind of pushes us a bit in the more bullish direction. When we look at VGK against the S&P 500, yeah, we have seen a massive underperformance ever since 2007. So massive downtrend here against the S&P 500. So obviously, being in the S&P 500 has been much better than being in the Europe ETF. Though you could of course be contrarian and argue that, well, doesn't that mean that there's potentially more value in Europe? And you could certainly make that case, but obviously we do have a downtrend. That's pretty clear. So you have to be a contrarian to see something bullish here. Though, having said that, the best investors of all time have actually been contrarians. The seasonality here is definitively it's not really that bullish. No, it's not bullish. We do have some mixed intel here. Okay, so when we looked at France against the Europe ETF, that relationship was potentially bullish because we did have a strong seasonality. Well, at least in terms of outperformance against the VGK, that's bullish. We did have that double top pattern on the technicals, so a bit of a battle here between the technicals and the seasonality. So this one is a bit messy. You do see that massive underperformance against the S&P 500, but given the whole situation here with Russia, you could potentially make a contrarian case for Western Europe. Because the major conflict on the horizon would be, between America and Russia and potentially allies of Russia. So it could be that Western Europe becomes, relatively speaking, a safer zone. Another thing is that there's massive incentives now for a stronger Europe. That Europe needs its own military to be able to defend itself. So we could actually have a situation where even America, which has benefited very tremendously from a weakening Europe, ever since World War One. It could be simply be that even America would actually like to see that Europe becomes much stronger financially and militarily. As such, that could be a setup for a situation where the European stock market ETF begins to outperform the S&P 500. But this is of course hypothetical. But it's very important to be aware that what is happening now, in Ukraine and all of that, it is also one of the reasons is that Europe is in this very strange psychological state, because ever since World War II, the entire narrative has been that military assertion in Europe, strong, fierce identity, it's very dangerous, because of World War II. But I think that at this point, that could actually change very substantially. Washington would benefit very much so from a very strong and assertive Europe. That could, be bullish. So I think I will give this very mildly to the bulls, just a 1. So we end up with a score here of 0.8, which means that I feel more bullish than bearish. A very key part of the bullish thesis is the 200 weekly moving average support. If that support fails, if that level becomes resistance, as we have seen, then it would be much better to just use it as a short level. Then yeah. Okay, but whatever you do, of course, you want to use stops and be market neutral.